In the investment world, Peter Lynch is regarded as an authority due to the fact that he put a large amount of power in the hands of private investors. His sage has touched many hearts among investors worldwide. According to him, individual investors are more potent than large investors. Also, he gave some tips on to new investors who just started investing to make them richer and more successful. And that's what we're going to discuss in today's video. So make sure to watch till the end. You see, there's a reason Peter Lynch is one of the greatest investors. Many people have successfully applied his strategy, and his success is legendary. Peter Lynch's investment and strategy is based on the simple principle that investors should invest in what they know. In other words, investors should invest in companies or industries they understand and avoid investing in companies that they don't. According to Lynch, investors should look for stocks that are undervalued and have growth potential. As an investor, he says you should stick with companies you know, such as those in your own industry or those you already know. According to him, investors should research companies thoroughly before investing, and they should look for companies with strong fundamentals and growth potential. A key part of Lynch's investment strategy is diversification. In his opinion, diversification reduces risks, and investors should diversify across different asset classes and sectors. Lynch also stressed the importance of having a long-term investment strategy. In his opinion, investors should be patient and look for investments that will compound over time. Among Lynch's many accomplishments, he is most famously credited with popularizing the phrase "buy what you know," by which he described his investment strategy to the public. In his opinion, investors should invest in companies that they're familiar with and understand, rather than trying to make predictions about where stocks will go in the future. Moreover, Lynch believed in the power of small hidden gems, stocks that have relatively little feedback or were not well known, but that had significant potential for growth, even if they were not widely followed or well known. His belief was that these stocks might be purchased at a lower price than their true value, which would give the investor an opportunity to realize an attractive return over a period of time if they were properly invested. During Lynch's tenure, he advocated to use the diversification in order to reduce risk and increase potential returns. According to him, the best way to invest is not to put all your eggs in one basket, but instead spread your investments across different industries and sectors rather than placing all your eggs in one basket. But in order to maintain a diversified portfolio, he recommends that investors periodically review their portfolios and adjust the individual stocks they own as needed to maintain a balanced portfolio. In Lynch's view, research has a tremendous impact on the success of his business. Prior to investing, he stressed the importance of research on the companies and their financials. According to him, investors should take time to understand fundamentals of each stock and make sure that they're investing in companies that have strong fundamentals and that they have the opportunity to grow in the future. You see, Lynch was an advocate for investing for the long term. It was his belief that investors should hold on to their stocks for a long time in order to fully realize the potential of their investment. Lynch believed that investors should not only focus on returns that they can see within a short period of time. A key priority of his was the importance of looking at the stock's long-term potential and the fundamentals of the company as a whole when analyzing stocks. You see, Lynch was a hard believer in the power of compounding. In his opinion, investors should take advantage of this power by reinvesting their returns to maximize the long-term results. And not only this, he was an advocate for patience. In his opinion, investors should not be swayed by the noise generated by the market and instead must be patient and wait for the right opportunity to present itself. However, he also believed in the power of margin of safety. Basically, Lynch advocated that investors only invest in stocks that have a margin of safety, which means that the stock was trading at the same price was lower than the company's intrinsic value. You see, Lynch is one of those investors who was able to achieve his success by following 3 simple strategies. So if you're a beginner investor, you should definitely follow the advice of Lynch. And that's it for today. We hope you liked the video. Make sure to give it a thumbs up and subscribe for more videos. We'll catch you in the next one.